Century Communities just dropped their latest earnings, and wow, the numbers are telling two totally different stories. You've got record sales on one side and a big hit to the bottom line on the other that has Wall Street a little confused. So today, we're going to dig into the report from homebuilders CCS and figure out what is really going on. Let's dive in. And this right here, this is the puzzle at the heart of the whole quarter. They beat on revenue, they beat on what we call adjusted earnings, but they missed on the official GAAP number. The result of all that, the stock went absolutely nowhere. So, which number should you actually believe? That is the big question we need to answer.
All right, let's kick things off with the headline numbers. This is where you can really see how Century is trying to navigate this incredibly tricky housing market and, why Wall Street just can't seem to make up its mind.
Just look at this contrast. Revenue was really strong, crushing estimates at $1.23 billion, and adjusted earnings, which is the number that kind of strips out some of the one-off costs to show you the core business, that also came in hot. But then you have the official GAAP number, the one with the strict accounting rules, and that was a miss. This is the exact conflict that has investors sitting on the fence.
So let's start with the good news, right? A 20-cent beat on adjusted earnings. That's a big deal. This is the number that management really wants you to focus on because it reflects how the core business is doing. And honestly, from that angle, the quarter looks like a real success. But, and this is a big but, we just can't ignore that GAAP miss. So what happened there? Well, it all comes down to a charge of almost $11 million for something called inventory impairments. To put that in plain English, they had to mark down the value of some of their properties. This tells you that even with all those strong sales, there were some hidden costs chewing away at their profits.
So how did investors take all this? Well, with a giant collective shrug. The stock barely budged. And that's the market for you in a nutshell. It's weighing all the good against all the bad and basically saying, you know what, I'm not making a big move here until I see what happens next.
So how did we end up with this totally split result? It all comes down to a very deliberate strategy for management. They call it their pace over price playbook. Basically, they made a clear choice to focus on selling more homes, even if that meant their profit margins took a little bit of a hit.
And did it work? Oh, you bet it did. They sold a record number of homes for a fourth quarter. We're talking up 13% from just the quarter before. And what's normally a pretty slow season for housing, that is a massive, massive win.
So how'd they pull that off? It's actually pretty simple. They offered huge incentives to buyers. These things jumped by 2 full percentage points from the last quarter, hitting about 13% of a home's price. We're talking about buying down mortgage rates, helping with closing costs, pretty much anything to get people to sign on the dotted line.
And they also got really creative with their financing. The use of adjustable rate mortgages, ARMs, it just skyrocketed. It jumped from just 5% of their loans all the way up to a whopping 25% in Q4. These loans offer much lower payments at the start, which, let's be honest, was a total game changer for buyers stretched thin by these high interest rates.
So here's the bottom line on their strategy. It was a really high-stakes trade-off. The wins were huge, no doubt. Record sales, less unsold inventory sitting around, and they were building homes at lightning-fast speeds. But the costs were also pretty significant. Shrinking profit margins, that GAAP earnings miss, and a pretty dangerous dependence on these incentives to keep the whole machine running. All right, so that's the story of the last quarter. Now let's turn our attention to the future. What is management telling us about what's coming up, and what does it all mean for the stock? Okay, so here's what management is promising for the year ahead. They're guiding for somewhere between 10 and 11,000 homes sold, which should bring in right around $4 billion in revenue. These are the key numbers you're going to want to watch. So, how are they planning to hit those numbers? Well, they've got two main strategies. First up, a really smart and flexible approach to land. See, they have options on thousands of lots, but they've put very little actual cash down. That means they can pull back super quickly if the market slows down, and it doesn't really jeopardize their future growth. And second, they're buying back their own stock, and a lot of it.
And listen, they are not just tinkering around the edges here. They bought back 2.3 million shares last year. That's 7% of the entire company. And get this, they bought them at a nearly 30% discount to the company's stated asset value. That is a massive vote of confidence from management. They're basically screaming from the rooftops that they think their stock is an absolute bargain.
Okay, so we've broken down the good, the bad, and the kind of ugly. Now for the most important part. What does this all actually mean for investors? So let's get right to it. Where does the stock go from here? That's the million-dollar question, isn't it?
Honestly, we think the stock is going to be stuck in neutral for a little while.
The Bulls, they've got the record sales to hang their hat on, but the Bears are pointing to those shrinking margins. It's a classic standoff. The real tiebreaker is going to be the spring selling season. Can they keep selling homes if they pull back on those big incentives? That is what absolutely everyone will be watching.
And that's why we're calling this a market perform. Their smart land strategy and their strong execution, that provides a nice safety net for the stock. But the pressure on their margins and their reliance on those incentives, that really puts a cap on how high it can go. Until they can prove they can grow profits, not just sales, we just don't see the stock breaking out of its range.
To put it as simply as possible, Century is playing the game really well. But investors need to see more than just good defense. They need a clear path to scoring more profits before they're really going to be willing to pay up for the stock.
And just a quick reminder for everyone, this analysis is for informational purposes only. It is not financial advice.